Good evening and welcome to this evening's webinar. Tonight we're going to talk about how PFA navigates in a turbulent stock market and what you should be aware of as a pension contributor. My name is Klaus Bielefeld and I'm your host tonight. I have with me my two colleagues, Tine Choi Danielsen, who's a chief strategist in PFA, and Carsten Holdum, who's a consumer economist. Welcome to both of you. Let me just mention that Tine is with us on a Skype connection from Malmö. We're in an unusual situation and we do not know how long it will last. Tine and Carsten will tell us about how we navigate across our PFA profiles, how we handle risk and what you should be aware of when it comes to your strategy and your long-term perspectives. PFA has an important role as a financial company, and we're still ready to pay out pensions. We are ready to receive your calls, to give you counseling in matters of health, and please make use of these options. Many questions may arise in a situation like this one. Before we start, I have a few practical remarks. First of all, this webinar will last for about 30 minutes. It's live, and that means that you can ask questions. You do that in the bottom right corner, where you can write your name and email address and your question. We will then answer your questions. I'm sure there will be lots of questions, so we will gather them together. And on our website, pfa.dk/corona, we will write out answers on a Q&A section of our website. So have a look at the bottom screen, but otherwise go to pfa.dk/corona. You can maximize your video player in the bottom right corner to a full screen mode. That will make it easier to see the details on the slides that we will be showing. You can exit full screen mode by clicking Escape. If you have trouble with the streaming or the technology in general, rest assured that the webinar will be recorded and it will be put on the website pfa.dk/corona, and we will expect it to be ready there for your viewing on Monday. No more practical remarks from me right now. I will pass the floor to Tine, who will tell us about the financial development and what the situation is like. Over to you, Tine. Thank you very much. I will just let my first slide speak for itself. It's a picture we have seen numerous times by now, and I'm sure we will be seeing it even more in the coming time. If we move on to the next slide, I will give you a brief update on the market development in 2020. We started very well this year, but since mid-February, the markets, especially the stock markets, have been in free fall. We have seen great fluctuations, and we need to go back to the financial crisis. It's that far back that we have seen fluctuations of plus and minus 5% on a day-to-day basis, seen in a period of time of 2 to 3 weeks. You can see the global share prices in Danish kroner here. This year they have taken a fall by about 25%. What is worrying us in PFA these days is the bond markets. As you can see, the European government bonds, as you can see on the yield here, until now, we have seen falling. That, where we can see that the shares have fallen a lot, but we can also see rises now. And it means that there's not really a safe harbor as usual, because typically we have this kind of insurance because interest rates will then fall in a situation like this. But we no longer have that situation. Interest rates are actually increasing, and there are several explanations for that. One of them being that we have seen a historically low interest rate level, and that means that we can't really get more out of these interest rates than we already have. Secondly, we have seen some interest rate falls in the US. We came from more than 1.5% when the virus hit Italy, and it reached 0.5% in the US at its worst. Now we're back at about 1% in the US. So we have been seeing interest rates and levels that reflect that we are in a recession-like condition. And finally, we have to say that all of these help packages and aid packages being sent out from global governments all over the world, we know that the big investors, particularly the bond investors, will have to pay the bill at some point. And that will possibly put pressure, an upward pressure on interest rates at some point. But of course, we're looking closely at the markets, and what we can see is that our usual safe harbor is not as safe as it used to be. If we move on to the next slide, you can see how our yield, our return on investment on our plus profiles have been looking this year. We have seen negative returns from minus 3.5% up to almost minus 18% per the 17th of March. Let me just warn you, of course, there is some fluctuations going on right now, so it makes it difficult to keep track on where we are exactly when it comes to our return. But as you can see, we are doing a bit better than the overall market when you look at global stock markets, and that is partly due to the fact that when we started 2020, we had an overweight of defensive sectors, meaning sectors with a stable consumption, these goods that we all need no matter what happens around us, like toothpaste, toilet paper, so on. Then we have our healthcare shares, which are typically also doing better in situations like these. And finally, we have supply companies in our portfolio as well, because we all need electricity and heating for our houses, and these are very stable sectors. And that means we have a kind of a buffer when it comes to the general market development. Furthermore, in our investments, we've had a lucky timing, so to speak, because just before the news about the Italian situation hit the markets, we really saw too much increase in the market. So we actually took our gains out at that time, and that meant that we were in a better position once the crisis hit. But we cannot steer clear of this crisis altogether. We will feel the effects of what is going on these days. Finally, what I usually preach when investors ask me what to do is that you should stick to your investment strategy, and that is our recommendation from PFA. As an institutional investor, we have many tools in our toolbox, and that means that we can adjust in many different directions when crises hit the market. And what we focus on a lot is that markets can turn around very rapidly. So if you don't have the right risk profile, that is the share of stocks that you want in your investment portfolio in relation to bonds, it means that you're not well equipped. So stick to your profile. And what we use as an indicator these days when it comes to figuring out when things are going to turn around in the stock markets, that indicator is the number of confirmed cases of corona. Here you can see it per 1 million inhabitants. And you can see that South Korea and China, the Hubei province, seems to be flattening now. So the development is turning around. So that is what we are looking for. What does it look like when it comes to the number of confirmed cases, and do the other countries seem to follow the same kind of pattern as we've seen in China and South Korea? And that is the tendency we are looking at. But of course, there's still a margin of uncertainty here, because particularly in Western Europe, many countries have stopped testing everyone for this disease. So these are just the registered cases that we can see in the sources we have access to. But we do believe that we will see a stabilization in the financial markets once we see this curve flattening in the US as well. We think that is what it takes for investors to actually believe that these initiatives being launched right now will actually work. And once we do see an effect, I'm sure that all of these restrictions will see an end, and then the investors will also believe that there's light at the end of the tunnel. Another thing worth mentioning is the massive aid packages that we have seen. That has stabilized the market somewhat after the European Central Bank has launched a corona purchasing program. So further to the 5 billion euros they started with to buy stocks and shares and bonds, now they are actually launching even more aid. So these are actually massive aid packages that are being launched these days. And I know that it might be a short-term reaction that we are seeing to this news, but of course we're following the situation minute by minute, and of course investors want to see some kind of stabilization, and the scale of these initiatives, these aid packages, are hugely important in order to give investors and give the market some measure of optimism. So investors are doing the right thing, but what we would like to see is, of course, that the US would take the same kind of massive initiatives as we have seen here in Denmark and in the EU. Now we have quite a good safety net under all of our companies here in Denmark with the initiatives from the government we've seen in the past days. But as an investor, you also have to remember that at some point someone has to foot the bill, and only one party can foot that bill, and that is the taxpayers. And that, of course, will try to avoid that this will put upward pressure on interest rates at a time when we expected them to fall. If we look at Greece and Italy, which are the two European economies with the largest government debt, well, here we are seeing the biggest increase in interest rates these days. But our assessment is that it's worth it and that these aid packages will mitigate the recession that we are headed to right now, because there should be no doubt that we will see a recession in the second quarter of this year. Sorry, the first quarter, says the speaker, and it will continue into the second quarter. One of the most important things to be aware of is, of course, the risks and the uncertainties surrounding our assessments and everyone else's assessment of the perspectives for economic growth, because we're in a situation that we've never seen before. We still do not know how this disease will develop and whether all of these social restrictions will have an effect or not. And until we see that effect, we cannot really guess at how long these restrictions will last. And of course, the longer they will last, the bigger the economic consequences will be. If we look at the next slide, this is our 3 growth scenarios. Our main scenario is a V-shaped development. And right now, I can only say that the world economy, and that includes Denmark, is going down towards the left leg of the V. Of course, the big question is how big this V is and how deep we have to go before we hit the bottom. And we're quite sure that once we do hit the bottom of this V and we start to see a lifting of all of these ban and social restrictions, then we will start climbing up the right leg of the V. We've seen that in China they've been quite slow to get activities up and running again, and we can see on surveys that people are quite careful these days. So these social distancing initiatives is not something that will automatically just disappear once the restrictions are lifted. And of course, as I said before, there is a great uncertainty surrounding these assessments. So we cannot exclude a longer-lasting recession. So we do assess that we're in a V-shaped development with a short-term, maybe 2 quarters of recession. So a V or a U, or perhaps the final scenario as an L, as we saw it after the financial crisis, where it flattened out and it took a long time to get things up and running again. Those were the words from me. Thank you very much, Tine. And we have already received a number of questions. One of them is, how bad can it get, and should I worry? That must be a question for you, Tine. Yes, well, as I said, there is great uncertainty as to how bad this can get. Of course, we are seeing tons of studies and assessments and evaluations of how this virus can develop. And of course, the fear right now, the concern is that with all of these social distancing initiatives, we might flatten the curve of the number of cases, which is also the strategy of the Danish government, because we're afraid of the pressure it might put on our healthcare. But as the Swedish Prime Minister said, it's better to get one case a year, 365 days in a row, than to get all 365 cases in one day. There will be 365 cases, but we're much better served taking them one at a time. So most people believe that it will fade out and then there will be a second wave in the fall. So that is kind of the worst case scenario right now, because that would also mean that these social distancing bans and restrictions will also last longer, or they will be reintroduced if they're lifted during the summer. And then it might be even more expensive to our society, to our economy, and to our companies. Of course, what we should keep an eye on is us, consumers, and our behavior. And also, of course, whether people start losing their jobs or not. And that is, of course, why the Danish government is these days trying to put a safety net underneath the economy and the companies, because if this ends up in massive layoffs, then it will lead straight into a recession. So, and in the worst case scenario of a U-shaped or even an L-shaped development. But with the initiatives and the aid that we're seeing being launched right now, the restrictions, but also the stimulating initiatives, it's very, very difficult to make an accurate assessment of where this will end. The only thing I can say that it's absolutely sure that we will have a deep negative growth in the month of March, and it will extend into the second quarter of this year. Thank you, Tine. A final question before I pass on the floor to Carsten is, well, our investment strategy in the short term. Yes, well, we look at the information that keeps coming in, and of course we stick to our investment strategy so that we make sure that we have the right risk for all of our customers at any given time, what we believe to be the right risk. And that also means that the past couple of weeks we have bought a bit of shares on the stock market. We have been selling out bonds, government bonds, because we have seen this negative interest rate development. There wasn't really any gains there. I'm not talking about a fire sale or anything, but we've been investing a bit in our portfolios, in bonds as well as in shares and in the stock market according to the current situation. And that also means that once we do see a turnaround in the markets, we will have a share of stocks. That means that we can benefit from the upturn once it comes. What I worry about is that our share of stocks will become too small, so we have to readjust on an ongoing basis to make sure that our mix of bonds and shares is the right one, because fluctuation may arise at any given time. We do not know, simply, so we need to be prepared in order to make up for lost time. And finally, let me just say that time is working for us in the sense that vaccines are underway, so at some point we know that we can start fighting this disease. Thank you very much, Tine, for that reply, and then I will give the floor to Carsten Holdum, who will tell us a bit more about what you should be aware of as a private pension contributor. Thank you very much. Of course, it's a serious situation on the markets. There's a lot of turbulence, and the whole world needs to take stock of what this new disease means to us. And what does it mean to my pension savings? Of course, that's the question we get from many of our customers. And of course, questions about the choice of investment profile is the pressing question. So let me take you into the engine room to explain why we have the recommendations in PFA that we do. There should be no doubt, so let me state this very clearly, that our recommendation is that you maintain your investment profile. You have been through an investment guide, and this decision has been made according to your personal finances and your personal situation in a moment of calm where you were not affected by fear and recent developments in the markets. Our experience is that that is the way to go in the long run, and pensions are long-term investments, and that is important to remember. So it's important to look at the long term and remember that there are good and bad years that cannot be avoided. And our product is already put together in such a way that your risk is greatest when you're younger and you have time to make up for it, while the risk is being phased out with age. And that means that the fluctuations will diminish with time and with age, and the risk will decline. Finally, one argument could be, well, what else would you do? Because it's very difficult to time the market. The market can go up, it can go down from one day to the next. So it's very difficult as an individual to keep track. Therefore, you should leave it to the professionals. And let me just take you through just why pensions are so long-term. Of course, it's a 70-year contract that you enter into once you start out in the labor market. And for many of our customers, that could be 30 or 40 years before you need to retire. We're in a situation where we live longer and longer. Of course, diseases like this will affect our life expectancy in the broad term, but on average, our life expectancy is increasing all the time, and we should expect to live till we're 90. Let me just take you through PFA Plus and how it works. You choose an investment profile by going through our investment guide. You cannot say whether one profile or the other is the right one for you. It's a personal choice, but once you make that informed choice, you should stick to it. We recommend a mix where we start out with a certain amount of shares in your mix, but then with age and with time, this share is scaled down and you convert into more low-risk bonds. And once you have a mix of bonds and shares, the thing is that once there are big gains to be had on the shares, then we sell some of it to realize some of these gains. And for you, that's a very good dynamic because you buy cheap and you sell when it's expensive. to put it simply. So what do our customers choose? This was the distribution at the end of last year. Most people choose a medium risk profile, as we recommend. Very few of our customers choose a very high risk profile, and that is mainly men, I can see. And if there's a lot of pressure on any of these customer groups, it will be these 13%, these high risk profile customers. But they are typically young people who can make up for this in the long run. And as Tine mentioned, we have seen a downward development in interest rates for the past 10 years, or for many years actually. I remember from my youth we had high interest rates, and that meant we had this safe harbor where you could always buy a government bond, and if you didn't want to take much risk, that was where you could go. But with time, interest rates have been approaching zero, and it has even hit a negative interest rate level right now. So that means we no longer have that kind of safe harbor where you could always put your investments as you could in the old days. And then we've switched from average interest rate to market interest rates, because in the long run, it will be more beneficial to you, our customers, to be out there with a certain amount of shares. If you do not want shares or stocks, if you put all your money in government bonds, you will, of course, get a result, but a very certain result, but it will be a certain loss, as interest rates are right now. So you have to have a mix. Finally, of course, we're not the only ones paying close attention to these numbers. These are the societal conditions for return on investment. This is not something we do. It's drawn off by a panel of professors looking at the conditions in society at large, and these are the expectations that they used 10 years ago. They would say, oh, bonds are doing good, shares are doing better, but they're both well above inflation, so both were a good choice, and you could have a safe harbor with government bonds. If you look at the expectations right now for the coming 10 years, interest rates will be about zero. That is less than inflation. So if you were to invest only in state bonds, government bonds, then you would lose purchasing power year on year. That is the dilemma we're in, and that you are in. Should we bet on bonds that don't give us any yield, or should we bet on shares, stocks that do fluctuate, but that also give us a return on investment? But you can see that the societal conditions for return on investment for the future are a bit lower than they have been. So the yield on shares has been extremely high for the past 10 years, higher than expected and higher than the market could actually tolerate. So therefore, the expectation is that from now on, the stock market will be performing quite well, but perhaps not as exuberantly as we have seen it for the past 10 years. So when we recommend that you stick to your investment profile, it's because that was a decision you made at a calmer time. And it's also because we can see from our experience that you will simply do better if you leave decisions to the professionals when the market is as turbulent as it is right now. This is the development in the stock market. This is not your pension funds, but you can see that once the fluctuations happen, they can happen quite quickly. Here we have the V's that Tine mentioned, and many have been surprised that you see a decline, and then you try to hedge your bets, and you try to invest in a more cautious way, but then it turns around again and you miss out on the increase. So our best recommendation right now is to look at the long term, stay calm, and let professionals like Tine navigate through these troubled waters. Thank you very much, Carsten. A lot of questions have been received here during your speaking time. Let me just take the first one, which is, I'm going to retire within the next 6 months. What do I do? What do you recommend? Of course, when you're approaching your retirement age, you're in a different situation than when you're young and you can make up for it in the long run. Of course, you might already have been in touch with a pension counselor in PFA, and of course it's a good idea to take a good look at it right now, because your profile should have been automatically converted to a more secure risk profile right now, but it would be a good idea to have a chat with us and look at what you should do. We're ready to talk to you, to answer all your questions and to counsel you. We're not closed down. We're ready to talk to you. We will just do it in a more digital way. Thank you very much. Another question is the consequences for next year's pensions. Of course, there will be a negative effect in the market interest rate. If you are on average interest rates, which some of our customers are, things are more stable. These are good schemes that were drawn up in the 90s, and they will benefit from it now. Customers who are on market interest rates, well, the negative impact we will see now will be spread out in the following years. But of course, we will see an impact next year. As I said, we have received many questions, and we'll try to gather them into bundles and make more overarching general replies that we can put out on our website. Of course, our customers are asking, what do we do in the here and now to avoid big losses? And let me again here refer to Tine. That is why we have an investment department. They are following the markets closely. And as Tine said, please stick to your investment strategy. That will keep things in the right framework. Of course, it will hurt when the negative impact is felt, but it will also be made up again once the markets go back up again. So don't sell out and miss out on the upturn. So that was briefly the recommendations of PFA. Now we're approaching the end of this webinar. I hope this has answered most of the questions you might have had before the start of this webinar. And as I said on our website, pfa.dk/corona, we will keep you posted about the market and what you should be paying attention to. And we'll be ready by our phones from tomorrow and in the coming weeks. So if there should be any questions that we haven't answered yet, please do contact us. So finally, let me just thank Carsten and Tine, and thanks to all of our viewers.